Nearly every modern economy has converged on the same institutional feature, a central bank sitting at the core of its monetary system. That convergence is so strong that the remaining exceptions are mostly curiosities rather than alternative models, because even the rare jurisdictions that issue their own money without a dedicated central bank typically lean on a larger neighbor's currency for transactions that actually matter. The reason this design became close to universal is not that central banks are beloved or that they never make mistakes, but that they solve problems that otherwise reappear with depressing regularity. When capital moves quickly across borders and when currencies float against one another, a central bank becomes a practical restraint on credit excess, a crisis firefighter when funding markets seize, and a semi-insulated referee for inflation and employment. If you're interested in personal finance, hit subscribe and give this video a like right now. And now, let's move on. Beyond those headline responsibilities, central banks also do a pile of administrative work that is easy to ignore until it fails. They keep payment and settlement systems functioning. They supply liquidity to banks so everyday transactions clear smoothly. And they help anchor the public's confidence that a unit of currency today will still be accepted tomorrow. Those tasks have become more demanding as supply chains and finance have globalized, as debt has expanded across households, firms, and governments, and as inequality has altered who feels policy changes first. At the same time, public frustration with institutions has intensified, and the sheer power of central banks has made them a convenient target for political theater. In the United States, that theater sometimes takes the form of talk about abolishing the Federal Reserve entirely, an idea that attracts everyone from risk managers trying to price a tail event to people convinced that monetary policy meetings are a cover for something far darker. From a practical standpoint, eliminating the Fed is extraordinarily unlikely because the institution is embedded in the wiring of global finance and domestic banking. The dollar is the world's most important reserve and transaction currency, and the Fed is central to how dollar liquidity is created, distributed, and stabilized. Pulling that out would be less like replacing a cabinet in a kitchen and more like trying to remove the foundation while still living in the house. Still, the question persists because earlier versions of central banking in the United States have been dismantled before, and because recent years have exposed genuine weaknesses in how modern monetary policy transmits through an economy. If you want to judge whether abolition is imaginable, it helps to trace why central banks were invented and what recurring failures they were meant to prevent. The earliest precursors to central banks did not begin as grand macroeconomic planners, and they certainly did not start with a tidy theory of inflation targeting. They grew out of European governments and cities, trying to manage debt and standardize money so trade could expand beyond local trust networks. Banking houses that served sovereigns gradually took on the role of coordinating coinage, extending credit to the state, and providing a stable platform for settlement among private banks. By the late 17th century, institutions like Sweden's early central bank and the Bank of England emerged in recognizable form, offering a centralized financial counterpart that could support government borrowing and smooth commerce with a commonly accepted currency. Even then, they were still evolving into the role people now associate with central banks, but they were already acting as a bank for banks and as a bank for the government. The United States tried to replicate some of that stability surprisingly early. In 1791, Alexander Hamilton championed a chartered bank that blended government involvement with private investment because the young nation needed a reliable financial infrastructure more than it needed ideological purity. A uniform currency and a central node for clearing obligations would reduce frictions across states and make it easier for commerce to expand. The plan was not universally popular, and the politics were intense because many Americans feared concentrated financial power and suspected it would favor elites. That tension mattered because the first attempt at a U.S. central bank arrangement ended when the charter was not renewed in 1811. The concept returned in 1816 with a second chartered bank, but that institution too became a political lightning rod and was ultimately dismantled in 1836 under Andrew Jackson, who argued that the concentration of power was incompatible with the nation's values. Those early American banks were not central banks in the modern sense of independent macroeconomic managers, and that distinction is part of why they were unstable politically. They were still profit-seeking institutions with special privileges. so they had to deliver returns to investors while also serving national financial needs. They also had to avoid angering lawmakers who could revoke those privileges, which encouraged caution and compromise rather than long-run design. When you build a monetary cornerstone on an entity with mixed motives, it becomes difficult to persuade the public that the institution exists primarily for stability rather than for private gain. Once those banks disappeared, the United States did not enter an era of clean competitive money. It entered a messy environment where many regional banks issued their own notes and trust became fragmented. That fragmented period created daily economic friction that is hard to appreciate from a modern perspective. If one bank issued a paper note, another bank might accept it only at a discount, or refuse it entirely because the value depended on the issuer's solvency and on the ease of redeeming the note. With so many different designs circulating, counterfeiting and fraud flourished, and ordinary people needed local knowledge simply to assess whether a piece of paper was reliable. Technically, the US dollar existed, but coinage was too scarce and inconvenient for the full range of growing commercial activity. So, private banknotes filled the practical gap. In other words, a large chunk of the money people used was effectively a promise recorded on paper by a private institution, with value resting on confidence more than on physical substance. That logic is uncomfortably close to how modern money works. Even if the interface has changed from ink to screens, most people now spend by moving balances in private bank accounts rather than by handing over bundles of notes. We trust that the numbers displayed in one bank's system will be recognized and settled against the numbers in another bank's system. And we rely on regulation, deposit insurance, and technological security to keep that trust from collapsing. The protection is not fancy engraving anymore, but rather a mix of legal rules, digital infrastructure, and the credibility of the institutions standing behind those balances. If you tried to persuade an outsider that today's bank deposits are fundamentally different from 19th century private notes, you would end up describing a shift in mechanisms of trust more than a shift in the basic concept. The weaknesses of a fragmented banking environment are most visible in a panic, because panic tests whether money is liquid and whether promises can be honored on demand. In 1907, the U.S. financial system experienced a severe run that exposed how over-leveraged and lightly supervised banks could become, especially when there was no dependable lender of last resort. Depositors rushed to convert claims into cash. Institutions struggled to meet withdrawals, and the resulting fear threatened to cascade through the entire system. In the absence of a formal backstop, a consortium of financiers led by J.P. Morgan coordinated emergency lending to keep key institutions alive. The episode demonstrated that even if individual banks were not insolvent, a sudden loss of confidence could still destroy them, and the broader economy would pay the price. That crisis set the stage for the creation of the Federal Reserve System in 1913, which was designed to provide a centralized mechanism for liquidity and to reduce the likelihood that bank runs would become systemic collapses. In its early conception, the Fed's job was not to fine-tune unemployment or steer stock markets. It was to keep the banking system from imploding when fear spiked. Member banks could hold reserves in the system, and the Fed could lend to them when withdrawals surged beyond what they could meet with cash on hand. By providing emergency liquidity, the Fed could reduce the incentives for banks to refuse withdrawals, which in turn reduced the likelihood that refusal would trigger broader panic. Over the following decades, as the relationship between money and gold changed and as convertibility was curtailed for citizens, the paper dollar evolved into a fully modern fiat currency, backed not by direct redemption, but by state authority and public confidence. Even in simplified form, this history illustrates the continuing central purpose of central banking, maintaining a reliable and flexible medium of exchange. That purpose includes distributing currency, protecting the integrity of the monetary unit, and sustaining the infrastructure that allows people to transact without constantly questioning the value of what they are receiving. As more countries built their own central banks, it became clear that these institutions could influence broader macroeconomic outcomes precisely because they sit at the intersection of money creation, bank liquidity, and government finance. Inflation, at a basic level, reflects the relationship between money and the supply of goods and services, and central banks are positioned to influence monetary conditions. Employment and growth are influenced indirectly because borrowing costs and credit availability affect investment, hiring, and consumption. In the United States, these broader responsibilities were formalized as the dual mandate, instructing the Fed to pursue stable prices and maximum employment. Many other central banks operate under similar mandates, although some focus more narrowly on price stability as their primary objective. What matters for understanding the Fed, however, is that it tries to deliver these outcomes with a remarkably limited toolkit. Unlike the federal government, it cannot simply build a program that directly employs millions of people to reduce unemployment. Unlike a legislature, it cannot rewrite tax codes or reallocate spending to target specific households. Instead, it mainly adjusts financial conditions and relies on a chain of responses that ripples outward from banking and capital markets into everyday economic decisions. The first and most discussed lever is the policy interest rate, often framed as an overnight rate that influences the entire structure of borrowing costs. When inflation is high, raising that rate increases the return to saving and makes borrowing more expensive, which tends to discourage consumption and investment that depend on cheap credit. If aggregate demand cools while supply remains roughly stable, businesses face more competition for each dollar of spending, and price pressures can ease. When the rate is lowered, borrowing becomes cheaper, debt servicing costs fall, and households and firms can spend and invest more, which tends to increase demand, and can push prices higher if supply does not expand in parallel. This is the basic monetary logic taught in textbooks, although real-world behavior rarely obeys the theory cleanly. A key nuance is that ordinary households and businesses do not interact directly with the Fed as if it were a retail bank. The Fed's most direct counterparties are banks and, through government finance, the Treasury. So, the policy rate works by shaping the incentives and constraints of financial institutions first. If the Fed pays a relatively attractive return on reserves or sets conditions for overnight lending that imply a certain risk-free benchmark, banks adjust their willingness to lend and the rates they charge. A bank that can earn a safe return on parked funds will not lend to borrowers at a lower yield, because it would be accepting risk for less reward. That dynamic sets a floor under broader borrowing costs, and those costs pass through into mortgages, business loans, auto financing, and the pricing of risk across markets. This is why interest rate policy often feels indirect, because it works through a sequence of intermediate steps, rather than by directly changing prices at a store. The Fed alters its target, banks adjust their internal pricing and balance sheets, lending terms tighten or loosen. Households and firms respond by spending more or less, and only then do shifts in demand place pressure on wages and prices. In that sense, higher interest rates resemble the brake pedal of the economy because they can slow an overheating system, but they can also increase the chance of stalling if applied too sharply. The second primary lever is open market operations, where the central bank buys and sells assets, typically government bonds, to add or remove liquidity and influence financial conditions beyond the very shortest term rate. The most dramatic version of this approach is quantitative easing, which expands the central bank's balance sheet through large-scale asset purchases. Under QE, the Fed creates reserves and uses them to buy assets, commonly government securities and, in some periods, mortgage-backed securities, with the goal of stabilizing markets and encouraging borrowing when fear would otherwise freeze credit. By bidding up bond prices, QE tends to push down yields, lowering borrowing costs and supporting asset valuations, which can prevent a financial spiral during crisis. Economists often summarize this as changes in the Fed's balance sheet, but that phrase can mislead people because a central bank's balance sheet is not constrained like a company's. A private firm cannot simply create spendable liabilities to buy assets, while a central bank can expand reserves as part of its monetary operations, and later contract them if it chooses. That special capacity also shapes how the Fed's finances appear. Because the Fed holds interest-bearing assets, especially government bonds, it typically earns income that covers operating expenses, funds a modest dividend to its member banks, and leaves a residual that is returned to the U.S. Treasury. For many years, those remittances were large, which made the Fed look, in a superficial sense, like a profitable institution that also supported public revenue. Recently, however, the Fed's accounting has swung into significant losses. During the pandemic, It bought a substantial stock of bonds when yields were low, and later, it raised policy rates rapidly to fight inflation, increasing the interest it pays on reserves and related liabilities. That created a mismatch where the Fed can be paying out relatively high rates while earning relatively low coupons on assets purchased earlier. For a normal business, sustained losses would imply incompetence or eventual failure, but a central bank is not a normal business and cannot be evaluated with the same instincts. The Fed can create money to meet its obligations, and its losses are largely an accounting reflection of policy choices across time, rather than an inability to operate. In practice, those losses show up as deferred remittances, meaning that future profits would first offset the shortfall before payments to the Treasury resume. Nevertheless, the optics are politically potent because people hear loss and assume waste, especially when the numbers are enormous. If someone wants an excuse to attack or restructure the institution, those headline losses can be marketed as proof of mismanagement, even when the underlying mechanics are far more mundane. Optics aside, central banks have faced real challenges in performing their intended role in recent years, and one of the largest is the combination of ballooning debt and widening inequality. Monetary policy is often described as a delicate balancing act, like trying to keep a stick upright on your palm because small disturbances can topple it. If the stick is very small, tiny movements matter, but if it is very large, its mass creates momentum that is hard to control. When debt levels are modest rate changes can nudge behavior without causing widespread damage. When households, corporations, and governments are heavily indebted, the same modest changes can quickly alter debt servicing burdens and trigger stress, defaults, and political backlash. That makes it harder to fine-tune inflation without causing outsized harm to some segment of the economy. The difficulty increases because inflation does not express itself uniformly across all categories. After the pandemic, consumer prices rose sharply in many countries, but asset prices had also been pushed upward by years of low rates and, during crisis, by aggressive easing. A significant portion of the liquidity injected through QE flows into assets because those with the highest propensity to invest in financial markets tend to be wealthier households and institutions. Instead of chasing groceries and basic consumption goods at the same rate, a lot of money chases stocks, bonds, and real estate, raising their prices. When equity prices rise, many interpret that as positive, yet when housing and commercial property surge, the consequences can be economically and socially corrosive, because shelter and business space are foundational rather than discretionary. This is where the interaction between inequality and policy transmission becomes crucial. Wealthier households often do not need to borrow to maintain consumption, so higher interest rates do not restrain them as strongly as they restrain leveraged households. If tightening reduces demand primarily among the indebted, it can cool measured consumer inflation, but it can also deepen distributional pain and leave asset inflation less affected. Some economists, including Joseph Stiglitz, have argued that in certain channels, raising rates can even reinforce inflationary pressures through real estate. Higher financing costs can push up rents and operating costs, which firms may try to recover by charging higher prices, complicating the story that rate hikes cleanly reduce inflation. The central bank may find itself squeezing the groups most sensitive to borrowing costs while having limited leverage over the spending and portfolio decisions of those least sensitive. The distributional outcome becomes even starker when you consider the sequence of crisis response and post-crisis tightening. During emergencies, central banks flood markets with liquidity to prevent collapse, which stabilizes banks and asset markets and protects employment in the short run. Over time, however, that liquidity tends to accumulate with asset owners because assets are the natural destination for surplus funds in a financialized economy. When inflation later becomes the dominant problem, central banks attempt to withdraw liquidity and raise rates, and the mechanism for doing so hits borrowers and workers first. The result is a public narrative in which central banks appear to rescue markets for the wealthy and then ask the broader population to bear the cost of restoring stability. That narrative has political consequences, regardless of whether the central bank's crisis actions were necessary to avoid a deeper catastrophe. At the same time, central banks increasingly operate alongside governments whose economic footprint has grown. Government spending as a share of GDP has risen in many places, and states have become larger employers, both directly through public employment and indirectly through procurement and contracting. That matters because the central bank is not steering a single unified economy anymore. It is steering an economy that includes a large governmental sector with its own incentives and constraints. When fiscal policy remains expansionary, with high spending and significant deficits, it can counteract monetary tightening aimed at reducing inflation. It can also generate political pressure to keep rates lower because higher rates raise government borrowing costs and can make fiscal choices look more painful. In theory, fiscal and monetary policy can cooperate. If inflation is too high and the central bank is tightening, the government could reinforce that tightening through contractionary fiscal policy, raising taxes and reducing spending to pull demand down more directly. Fiscal tools can also be targeted, using progressive taxation to reduce demand among those who are least constrained by borrowing costs, which might lessen the need to rely on interest rates that disproportionately stress debtors. In practice, especially in the United States, governments often do not choose that path because it is politically toxic to cut spending or raise taxes when voters want relief. When spending stays elevated and taxes are cut or kept low, the central bank can feel like it is fighting inflation with one hand, while fiscal policy pushes demand upward with the other. Supply-side factors further complicate this battle. Trade tensions, disruptions in logistics, and constraints on production can raise prices regardless of domestic demand, meaning that even aggressive tightening may not quickly restore price stability. When people experience high prices and then experience higher borrowing costs and weaker labor markets, they may conclude that the central bank is both failing and harming them, even when the underlying drivers are broader than monetary conditions alone. It is in that environment that proposals to curb or abolish central bank independence become politically tempting. If the central bank is unpopular, and if it seems to be at odds with elected leaders, it becomes easy for politicians to claim that eliminating the institution would restore democratic control over the economy. Technically, it is possible to imagine a Treasury Department absorbing the core functions of a central bank, because there is nothing supernatural about setting rates, managing reserves, and acting as lender of last resort. A disciplined fiscal authority could, on paper, administer currency, supervise banks, and provide emergency liquidity in a crisis. The issue is that the word disciplined is doing almost all of the work because monetary restraint is usually unpopular in the short term. Politicians operate on election cycles and therefore face constant incentives to stimulate now and worry later, especially when voters reward near-term prosperity and punish near-term pain. Central bank independence was built precisely to counter that incentive structure, ensuring that someone could raise rates and slow an overheated economy, even when doing so would be politically inconvenient. When that independence is compromised, the historical record is full of ugly outcomes. If the authority controlling money cannot credibly tighten because leaders refuse to accept short-term costs, inflation can spiral and expectations can de-anchor, making the eventual correction more severe. A modern illustration often cited is Turkey, where political leadership pressed for low interest rates and removed central bank officials who resisted, under the belief that growth would solve inflation and financial fragility. The outcome was not a neat growth miracle, but a painful surge in inflation, currency weakness, and broader economic stress that took years to confront. The United States has stronger checks and a more complex system, but the underlying lesson still applies. A monetary authority that cannot make unpopular decisions tends to postpone them until the costs multiply. It is also important to remember that the Fed is not a single person or a single building that could be switched off like a light. The Federal Reserve System consists of 12 regional reserve banks with their own leadership structures and a governance design that blends public purpose with a distinctive relationship to member banks. That architecture was shaped by political compromise, including the desire to disperse power geographically and reduce the fear of a single centralized financial monarch. While the details of that structure are not necessary to understand what an interest rate hike does to a mortgage, they matter enormously for any attempt at institutional upheaval. Abolishing the Fed would require not only a legal rewrite, but a re-engineering of the banking system's liquidity backstop, payment infrastructure, and global dollar relationships. When people ask whether the United States could eliminate the Fed, the more revealing question is usually why they want to. Sometimes the motivation is frustration with inflation, sometimes it is anger that unelected officials influence employment, and sometimes it is suspicion that complex institutions must be hiding sinister intent. The irony is that the very complexity that breeds distrust is also the complexity that allows modern economies to function without constant monetary crises. Central banks are imperfect, and recent years have highlighted how debt, inequality, and fiscal conflict can blunt their tools and inflame public resentment. Yet the alternatives, especially those that collapse monetary authority into short-term politics, have repeatedly produced outcomes far worse than the frustrations that inspire the abolition talk in the first place.